with our topic today, the interest rate rises. Are we there? Are we there yet? And we have an expert. This expert, I know Campbell Hastie very well, and he is a Hastie Mortgages. And how fitting is it, Campbell, that we're having a conversation about interest rates directly after the Reserve Bank lift the official cash rate by half a percent yesterday, and here we are talking about interest rates. How are you today, first of all?
I'm very good. I'm very good. Tēnā koe and kia ora koutou katoa to everybody else out there. Yeah, really good timing. I'm not known for my timing, but this is really good.
Well,
With an OCR increase yesterday. Yeah.
You are known for many things. You have a magic wand. That was our last conversation last month. But if you have a question, more important, if you are on any of our social media channels and you're watching this, if you have a question, please use the comment section, the chat section, put a question in there. If we don't get to answer it today, Campbell can come back into those platforms and answer those questions. But let's dive into it. The question on everybody's lips is interest rates, and I guess, will the rates, Campbell, keep going up, or are we at the peak?
Gosh, that's the $1 million question. Short answer, I think, is that the OCR will keep going up, right? The commentators out there who are probably more knowledgeable than me, economists and the like, are picking that the OCR will get to 3.5%. And whether or not we get to that level, it's almost anyone's guess. I think things will go up from here, though. That's the short answer in terms of the OCR. The OCR influences the short-term fixed interest rates that you and I pay, and the floating mortgage rate mostly. It affects the short end, in other words. We haven't seen any of the banks increase their short-term or floating mortgage rates yet, but I suspect we'll probably see that by the end of the week, which is tomorrow, and certainly into next week. The longer-term fixed rates actually are the ones that really make people nervous or interested, to use that term, because God, 80% of people who have a mortgage in New Zealand have it on a fixed rate, and they want to know what's going to happen to that one. The thing with those fixed rates is that they are influenced more by wholesale money markets, the international money market, than they are by the OCR. So you have to look at what's happening internationally, if you like. A couple of weeks ago, in fact, was it a couple of weeks ago? Yeah, there was actually a reduction, believe it or not, to the 2-year fixed interest rate, right? A reduction, that's right, not an increase. And that reflects what's happening on the international money markets. You hear about 10-year bonds and 3-year swap rates, those sort of silly terms. And they are actually having more of an influence on those fixed interest rates that you and I, as Kiwi borrowers, love to use. So I think here's another tip for people out there. I think the tone that the Reserve Bank use when they're talking about getting on top of inflation, that's as important as the OCR itself. They have to keep up the rhetoric, I think, around that spending restraint and that they're all looking for from us, and using the word recession and all that stuff to try and get us to stop spending our money so much. They've got to use the stick as well as barking about it. So it's more than just one thing that's going on here. But short answer to the question, yep, I think OCR is going to go up a little bit more from here. I would say fixed interest rates are likely to go up a bit more as well, but we shall see. What the Reserve Bank's really looking for here is spending restraint, right? Spending restraint.
But do you think, Campbell, that if you look back to, I know it was a different year, we were in lockdown, but people still kept on spending online. I saw a post today, a very well-known accountant on LinkedIn talking about, whether it's a recession, people still spend. So is this spending restraint actually happening?
It's starting to. It is starting to. Particularly for those of us with mortgages who have already experienced a bit of the increase in interest rates. It's actually hitting our pocket now. So it is starting to kick in. And if you look at spending intention surveys Tony Alexander, the well-known economist, he puts one of these together on a regular basis. It might be monthly, I think. There was one he put out the other day, and you have a look at that. Sentiment is changing. So people are saying, "Oh, I'm going to stop, going out so much, and I'm not going to buy that new fridge or whatever it might be." That's what they're saying. It hasn't quite flowed through into the numbers that you see going through the till of, your average retailer or GDP numbers. But my guess is that it absolutely will over the next, between now and Christmas, over the next few months. Let me give you an example here, just to sort of flesh this out as to what that spending restraint might look like in terms of economic impact. So I did a test in terms of my own client base, and I said, okay, how many clients have I got? What's the average loan size across? And there's about 600 active customers there.
Yep.
The average loan size is about $500,000, 503, in fact, was the number. And I said, okay, if we know half of those mortgages in the country are going to reprice from like 3.8% to 5.8%, that's roughly where the rate is now. What does that mean in terms of, the interest cost that's going to get sucked out of the pockets of all of those people in my client base? Well, the answer is half the mortgages repricing like that means about 150 grand worth of interest, extra interest that's going to have to be paid per month in my little client base.
Wow.
You times that by 12. Let's do it here. 150 times 12. That's $18 million a year worth of money that is not going around the Orewa community, at the bars and the restaurants and wherever else it might get spent, new tyres on the car or whatever. So that spending restraint is going to turn into reality by about January, right? So it's going to happen. Inflation will therefore be under control, and it'll get more under control, and that's all about interest rates having gone up and just sucked the demand out of the economy. The spending restraint will happen. Short answer.
And that's that time. You mentioned January 2023. That's the time they're talking about when the recession potentially will kick in. I guess looking back to those two previous quarters. So they talk about OCR increases in terms of least regrets. Least regrets. What does this mean?
Yeah. Adrian Orr, the Reserve Bank governor, he likes to talk about least regrets. What he means is that he wants to make absolutely sure that inflation gets back into the 1% to 3% band that he has to operate within. It's running at about 7% now, 6.9, call it 7, whatever. It's running about double the range that he wants to have things in. So he's going to make absolutely sure that it comes back. And so least regrets means keeping his foot on the brake, making sure the OCR continues to go up and holding it there. That's what he means by least regrets. I actually think what that means is that he'll hold on a little bit longer than is necessary. And that's a little unfortunate, but I understand that if he wants to get inflation under control and he wants to make absolutely sure of it, then he's probably going to have to hang on a little bit too long. His foot's going to have to be on the throat a little bit longer. What it means for you and me is that interest rates will probably overshoot where they need to go to. So I'm thinking they might get to, say, 7%, right? And then they'll settle back a little bit from there because they will have overshot. And we'll go, it's like the turbo lag in a boy racer car, right? The car's still going even though the foot's off the gas because the turbo's still spinning. It's a bit like that. But eventually the lag comes off, and I think that the interest rates will settle back. So it'll like a reverse bounce. Is it?
It's probably a bit like when you cook the prawns. You cook the prawns in the fry pan, and then you flip them after about a minute, and then you take them off after 30 seconds to kind of talk about that lag. They still keep cooking even though they're off the heat. There we go. So we're not at the peak there. We're not at the peak yet.
No, I don't think so. We're close. I think we're close to it. The interesting thing about peaks, peaks and troughs in economic changes, is that you don't know you don't know you're there until you're about 6 months past it. Yeah, you only see the peak or the trough in the rearview mirror. Speaking of boy racers, so I think if retailers report a shitty Christmas, and poor trading, I think we will have found ourselves beyond the peak. We've shot past it. We'll see. I think the Reserve Bank would like to see that happen. But the good news from there is that once we're at that point, and the Reserve Bank have some comfort around that spending restraint, they'll loosen things off, right? They'll loosen things off, and that should be good news for some people.
Is it going to be good news, those for house prices? What is this? What does it mean for the next, the rest of 2022, early 2020? What does that mean for house prices?
Well, there's an inverse relationship between house prices and interest rates, right? Generally speaking, rates go down, prices go up, and the reverse is true. So I think what it means is that house prices will continue to drop. How far they'll go, I don't know. Probably not too much further than where they're at now. Some people say 20% from where they were last year. I don't know. What I can tell you is that that's exactly the news first home buyers they've been gagging for a long, long time, because this group of people have just seen house prices go up and up and up, and it just seem they can't keep up. They can't run hard enough to keep up in a lot of cases. So, for that group of people, it's really good news, and they should be doing all they can now to prepare themselves for when the peak is when the peak has gone past us. For when the peak arrives, that loosening starts to happen. If they're ready, it smacks of opportunity for that group of people right there, so long as they're ready.
But speaking about first home buyers, if you think about, the lending criteria is still in place, largely, and the banks aren't really helping first home buyers.
Yeah.
How do you see that in terms of that lending criteria?
Well, you're dead right in terms of it being bloody hard for that group of people right now. When we think of first home buyers, we're really talking about people with less than 20% deposit, right? That's the group that find life the most difficult. And the Reserve Bank have restrictions in place in terms of lending to people with less than 20% deposit. And it essentially means if you're in that category and you want to buy an existing property, not a brand new one, but an existing one, you're out of the market until those restrictions change, right? But I think that it will change. We've seen it in the past. It has changed. Those restrictions have tightened up, then those loosened off. They're now in that sort of tight phase. But as inflation eases, and this is the interest rate response, and the economy finds a new level, so those restrictions will loosen off. And what you'll find is that when you get to that point, prices will probably be at their lowest ebb, right? And if you've done the prep work, you'll be in a position to pounce, if you like, to do something about it. You'll probably miss the boat if you haven't done that preparation now. But that just describes the ebb and flow of things. So, life in the property market might look pretty gloomy at the moment, particularly for the first timer. But that's on its way to changing. And the inflation and interest rate response is all part of that.
You've said before that whether you're a first home buyer or you're investment, whatever it might be, if you're looking to get money, it's about preparation.
Yep.
So first home buyers need to get their shit together. What about those with mortgages, if we look at those other people?
Yeah, so that group of people, well, they have a different set of priorities, I guess. They're not necessarily looking to move on. They just want to know how they can, what they need to do to manage their mortgage right now. And the question on their minds, and I'm getting this, God, every day, is where are rates going to go and how long should I fix for, right? So they want to know how high the peak is going to get to, and then when is it actually going to happen? Because what they're trying to do is pick a rate now that sees them through into the other side of the peak, right? So they're not coming off a fixed rate right at the top and having to face whatever that rate might be. I've just mentioned 7% before. You don't want to do that. You want to be on the other side of it. Look, it's tempting to fix long, like right now, go 3 years or 4 years or 5 years, fix for that sort of period of time. But I'd caution against that. Excuse me. I'd caution against that. We saw people doing that just after the GFC, or sorry, just prior to the GFC, where rates were going up, 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 and there was this fear that, oh my God, they're never going to stop going up, and we're going to get stuck. Well, that's actually what they did do. They did get stuck because they locked in at about 9%. Some of them for like 5 years or something, and they really were stuck because the GFC came along, rates went through the floor. From 9 to 6 virtually overnight, and those people were really stuck, and that's all a result of fear of this inexorable rise in rates. And fear makes you do some dumb things, as we've discussed previously, right?
Mm-hmm.
So, look, the solution here is for people to, in my view, to break their mortgage into a couple of bits if they haven't already, and fix those couple of 3 bits for different periods of time. What it means you'll end up doing is cutting an average through your interest rate profile. It means you'll spread the risk out. You'll never hit the bottom there, and you'll never pay the cheapest rate with this strategy, or if you do, it's just a fluke. But hopefully you never pay the top. You never come off during that peak either. And so it's a way of hedging your bets. That's probably the best advice that I can give people. But let me qualify that. Whatever you do, it's got to pass the sleep test, and it's got to be suitable for your situation. So please don't rush out right now and look at your app and go, right, I'll take 2 years because Cam said so on a video I was watching. Don't do that. Take some advice. But in general terms, splitting it and spreading it makes a lot of sense. This is what the people do in the international money markets when they're talking about billions of dollars. So you and I should probably take a leaf out of their book when we're talking about our piddly little $500,000 mortgage or whatever.
Last question for you.
Yeah.
Last question for you. From your workload, obviously, to answer that question, you said with first-time buyers, get in early, have that conversation. Campbell at hastiemortgages.co.nz, you've got a calculator on your website where people can go and do a bit of calculation. So get in, have that conversation early if you are a first-time buyer. But equally, have that conversation with Campbell. I think we're allowed to do shameless plugs like this, aren't we? Of course we are. So last question: are you seeing from your workload any drop off, or you're still pretty consistently busy talking to clients or to new clients?
Well, look, our client base is of a size where it has its own momentum, so we're not sort of twiddling our thumbs, as it were. But it's a fact that the overall pie, the lending pie, is shrinking. And it will continue to shrink for some time, I would say. I've got that on good authority from a couple of lenders I've been speaking to over the last couple of weeks, that the volume of lending transactions is shrinking. And that just reflects what we're seeing in the market. Fewer transactions in terms of property transactions, sales and purchases, more hesitancy on the part of both sellers and buyers. We talked about the fear of overpaying a few weeks ago. That is rampant now. So it just creates that hesitancy for people to enter into a property transaction. So yeah, to answer your question, yes, we're seeing less. We are seeing less. But, in terms of what the Reserve Bank is trying to achieve, that's kind of a good thing. People have got to buckle up, I think. They've got to look at their budgets, make sure they understand what their capabilities look like, see if they've got funds in reserve, whether that's via redraw facilities or literally cash in the bank, and hang in there. Hang in there. Yeah.
You're not going to die.
No. It might hurt a little bit, but you won't die.
Always a pleasure having a conversation. If you are watching this in the replay, and again, if you have a question, please drop it into the chat, into the comments, and Campbell can come back and have a conversation with you and answer your question. Campbell, always a pleasure. We shall talk to you again very